Housing markets have defied the doomsayers, those calling a recession and suggesting we're going to have a fixed rate interest cliff. 8 months of house price growth and 4 months of interest rate stability have forced even the most pessimistic forecasters to change their minds. And in today's Property Insider Chat, Dr. Andrew Wilson and I explain what's happening with interest rates, with inflation, with our rental markets, and what's likely to be ahead for our housing markets. If you want to keep up to date with what's happening to our property, real estate and economic markets, please subscribe to this YouTube channel. Click the little bell icon so we can keep you informed each time a new show comes out. 8 months of house price growth and 4 months of interest rate stability have forced even the most pessimistic forecasters to change their mind and predict more growth in our property markets. This surge of confidence is because house prices have been consistently rising, and the reason, of course, is the demand for homes has been exceeding supply. And it's much the same with our rental markets, where the supply-demand equation is so far out of balance that we've experienced an unprecedented rental crisis with historically low vacancy rates and skyrocketing rents. So I'm keen to hear from Dr. Andrew Wilson today as he walks us through the latest My Housing Market Rental Report. And I'd also like to get his thoughts on the future of interest rates in light of some of the latest data on inflation. Hi, Andrew.
Yeah, good day, Michael. And I guess another week and another revision of some of the doom and gloom forecasts that we've been living with. It seems like forever, but certainly for the past decade or so. And we've had some revisions again on one of the issues to do with fixed rate mortgages that was a fixation of the media for the last year or so.
It has been. Well, I guess it's no surprise now, it's old news, that the Reserve Bank kept the interest rates at 4.1% for the fourth consecutive month in October, and they cited a more sustainable balance between supply and demand in the economy. But Andrew, they also voiced their ongoing concerns about inflationary pressures and a heightened level of uncertainty surrounding the economic outlook.
Yeah, well, that's right, Michael. And no surprise, I think everybody predicted that they'd be on hold again. Personally, I think they've gone too early with the wait and see approach. 5 pauses over the last 6 months, and really nothing's been revealed in terms of the impact of higher interest rates on the economy. Inflation, until recently, had fallen. We had a bit of a shock rise, I guess, in inflation over August, where we saw the headline inflation rate rise. But of course, what we're seeing is the price of oil now having its impact on inflation. Oil prices have really bounced back over the last month or so, although some relief over the last week, Michael, in the price of oil, back now under $90 US a barrel. It was heading towards $100 US a barrel, which is a big number, particularly when we look at the pre-COVID price of oil, which was in the $30 and $40 range. But unfortunately, with what's happening in Israel, we may start to see some upward pressure on the price of oil again, and that has already paid its way into the inflation rate. The Reserve Bank, in its statement reflecting its Tuesday decision, mentioned the fact that they'd seen the price of oil had been a contributor to higher inflation. We have discussed that here, but notwithstanding higher inflation and an absolutely booming economy still, the Reserve Bank has decided to keep rates again on hold. I think we're well short of being even close to thinking we've controlled inflation with monetary policy. I think the lower inflation until recently has been a result of just the balancing out pre-COVID of the stimulus packages that created so much demand, and of course supply couldn't keep up. We're now seeing that regulate or re-regulate itself, and that's really got nothing to do with interest rates. Look, as economists know, as they should know, the last little bit is the hardest bit, Michael, to cool in terms of inflation. That's where the real work starts. We're still 1% below where we were at our previous rate cycle, and I'm not sure a couple of 0.25% increases, if the Reserve Bank decides to start to increase again, reflecting that inflation is starting to rise, will have any effect on the position. And I think that what unfortunately we may see is, because the Reserve Bank has been a little trepidatious about putting the foot on the brake, we may have to see them slam the foot on the brake down the track sometimes. Maybe not, maybe things will work out. But the latest data from the US is not encouraging, Michael. Despite all of the economists' forecasts, and gee whiz, I reckon economists should just give it away. They're consistently wrong in what they predict in regard to the economy, and the American economists are probably the worst of the lot. But despite widespread predictions, and of course the financial markets are driving this, they have skin in the game, so we shouldn't listen to them anyway. But there were predictions that we would see in the US that the jobs numbers would fall, validating the fact that we don't need any more interest rate rise and increase. Now, that didn't happen. In fact, we saw a remarkable surge in jobs growth in the US over the previous month. In fact, the month data before that were revised upwards. So the American economy is just steaming ahead at the moment. Of course, this has changed a lot of the forecasters, the outlook for interest rate policy in the US. And the US inflation rate is actually around about 1% lower than ours. So it's if they're concerned about the outlook and are now thinking about higher interest rates, I think that's something that we have to consider, because our economy is just as strong. We would have had a record low unemployment rate if the participation rate had have remained where it was the previous month, even though the ABS is trying to talk down retail sales data. Not sure what their agenda is. Retail sales data is still rising. It's still well above where it was a year ago, which was where we were peaking at that because of the remarkable stimulus packages. And, we're 30+% higher in terms of retail spending than we were prior to COVID. So even accounting for inflation and accounting for population growth, you can't dismiss high retail sales at the moment. So really nothing is giving, I believe, the Reserve Bank any sense that monetary policy has worked. And the fear that I have is that they're going to have to, at some stage, revisit higher interest rates going forward. But look, at the end of the day, Michael, steady rates is really good news for mortgage holders and really good news for the housing market, particularly with this booming economy we have now. Still quite positive consumer confidence.
Now, we've of course got to respect that some people are having challenges with their mortgages and the cost of living, but twice a year the Reserve Bank puts out a financial stability report looking at the stability of our economy and the financial system. And it last week mentioned that despite interest rates going up significantly, most households are handling it well without causing problems for our economy. Andrew, it wasn't that long ago that there were predictions of recession in our economy, and of course that fixed rate interest cliff that hasn't occurred either.
Well, we've discussed this at length, Michael, because it has been a focus in the media, more doom and gloom, more catastrophic predictions that what would happen as a result of the cliff, but it ignored the reality. It was just grist to the mill for the publicity seekers, for the clickbaiters. But, when we do have our policy makers, such as the Reserve Bank, buying into this nonsense, it is a concern. And the last thing the Reserve Bank I would have thought needed at the moment is more question marks over their competence. But once again, they've had to backtrack on what their concerns were about this so-called financial cliff that we were going to fall off when those that took those low fixed term rates a couple of years ago had to refinance. Nothing of the sort has happened. In fact, our default levels and arrears levels are very, very low still. People are paying their mortgages despite perhaps those that have had to take a higher interest rate with refinancing their mortgages. And of course, that reflects the fact, Michael, and we've discussed this, that firstly, they would have made considerable savings taking those low mortgage rates in the first instance. So that was money in the bank. They did have money in the bank anyway through COVID stimulus. We have a very strong economy with incomes growing at near the fastest rate in a decade. And of course, property prices have been rising, very solid to strong rises in property prices this year so far. And it's not in the bank's interests to put people under pressure unnecessarily. Given those positive economic circumstances, we've seen absolutely no problems generally in terms of the refinancing. And once again, it's all quiet, when we mention this to the financial media or the media generally. And of course, policymakers who got sucked into this negativity now look like fools again. And that's, really a concern. particularly to those that listen and make financial decisions based on this flawed advice.
Well, I know that my housing market doesn't just look at housing prices and the economy, but spends a lot of time analysing the rental markets around Australia. And you've just completed your September rental market report. What's happening, Andrew?
As we mentioned in the previous report, the August report, Michael, we saw a tightening of rental markets. Vacancy rates, which are already tracking at record low levels, fell consistently in most capitals for both units and houses over August. And we did discuss that this was perhaps a reflection of the beginning of the second half of the tertiary year, and international students, obviously with a higher demand, particularly for units, had put downward pressure on vacancy rates. But we saw a bounce back, predictably perhaps over September, with vacancy rates rising, consistent rising of vacancy rates almost in all capitals, but still remaining at very, very low levels, Michael. I think it's just that adjustment from strong demand in August back to more normal demand, if we could call it that, over September. But we've also got to remember, Michael, when we have very low numbers of vacancies, which we have now, we know that we don't have to look at that vacancy rate and rental data. Just about every capital, there are very low vacancy rates, exceptionally low, record low vacancy rates. That means that movements from month to month can be exaggerated because we've only got small numbers. So it doesn't take a big shift from month to month to have an impact on vacancy rates because they are at such low levels at the moment. But certainly we did see some rebalancing. But the market still remains well and truly in favour of landlords, Michael, and perhaps some sense of those higher vacancy rates eased rental growth compared to August. But I don't think we have any prospect, unfortunately, for tenants of an improvement in our rental markets in the foreseeable future, despite a myriad of policies that are being presented by governments to increase supply. So Brisbane was the big mover in house rents over the month, Michael, up by 3%. Most other capitals were either flat or rentals fell over the month. The annual results obviously remain pretty much the same. Melbourne's had the highest increase in house rents over the year, up by 17.3%, Sydney up by 15.4%, and these are big rises, of course, but Melbourne's coming from a lower base. Sydney's rent remains around about $200 a week higher than Melbourne's rent, and Hobart now, which is its rental market has been softening recently, Michael. We also know that its buying market's also been softening recently as well. So some sideways and downward movement in both rents and prices in the Hobart market, and that's really clearly the underperformer in terms of house rents over September, and it recorded a 2% fall in house rents. When we look at unit rents, Michael, a similar performance, with the exception of Sydney, which bounced back quite strongly to its previous peak, with rents at $750 a week now, which is the same as houses, Michael. High demand for units in Sydney. And as I said, bounced back up by 4.2% over the month. Other markets were flat or lower marginally for unit rentals. And that Sydney rent is still tracking, or now tracking at 31% higher, Michael, than where it was a year ago. And most unit rents have really exploded over the past year, of course, reflecting the impact, particularly of international students through COVID, the lack of demand there, but bouncing back strongly now. Brisbane rents up nearly 22%, Melbourne rents up 25%, Perth rents up 22% over the past year. So we've had some quite strong growth in annual rents, Michael, and it's still a very tough market out there for tenants, particularly now with those Sydney, quite extraordinary that Sydney unit rents are tracking where house rents are. And I think it's also interesting when we look at house rents in the other capitals, the Sydney unit rents are hundreds of dollars higher than house rents in the other capital city markets, which is a very sobering reflection on just how tight that Sydney rental market is. But it's not on its own. Just about without exception, all rental markets are suffering from lack of stock at the moment.
And as you said, despite all the government talk and the various committees coming up with ideas, there's really no end in sight to this. Those changes that they're talking about, the supply of over 1 million properties, 1.2 million properties, isn't going to come for some time yet. I'm not sure that anything further has even come from it. All there's been is a lot of talk. I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process. It's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. The auction markets are now back into spring selling season, following a couple of weekends distractions with grand finals and school holidays and public holidays. How did our auction markets perform over the weekend, Andrew?
Well, predictably, Michael, there were a lot of distractions previous weekend. We had long weekends just about in every capital city market. The distractions of AFL and NRL grand finals. And of course, there were the Labor Day long weekends as well. So we only had small numbers of auctions because of that in the previous weekend, but markets bounced back. We had big numbers of auctions the weekend, and coming from lower numbers, of course, once again, that tests buyer depth. But, good news with RBA keeping rates on hold will continue to keep buyers reasonably positive about the outlook and the affordability measures at the moment. So Sydney had 800 auctions, up from 545, Michael, big jump. And Sydney's had a few weekends over the last month or so above 800 or at or above 800, which is a big number for Sydney. Clearance rate down a little bit from its peaks, but still over 70%. So we'd still call that a seller's result, Michael, with 7 out of 10 auctions selling under the hammer and still ahead of where it was a year ago. But as I said, 200 extra auctions compared to the same weekend last year, Michael, and still with a higher clearance rate. I guess that says it all about how the Sydney market has progressed this year. Big number in Melbourne, Michael, nearly 1,000 auctions in Melbourne. That was clearly the biggest number of auctions so far for the Melbourne market this year. And look, I think a good result there for Melbourne. Melbourne's been tracking around about the 70% mark for most of the last month. It has come off its highs. Its highs were in the mid-70s 2 months ago, but just tracked a little bit that downwards of that Melbourne market, Michael. And we have discussed that Melbourne has just moved sideways a little bit over the past month. But given 1,000 auctions, Michael, I think a 70%, which was just about the same as the fortnight before's result, where we had the Super Saturday of auctions, which actually wasn't as big in terms of numbers as Melbourne had last weekend. More auctions in Brisbane, steady result, 60% in Brisbane. We always discuss the vagaries of that Brisbane market, but a 60% result reflects good buying activity in Brisbane. Adelaide numbers surged after their football distractions, particularly of the previous weekend, and another 80% plus. We tend to, I guess, ignore Adelaide to some degree, but it just keeps producing those big auction clearance rates, 80% plus. So a good result from high numbers of auctions and well above where it was a year ago, and for clearance rate as well. Canberra, big number. Canberra's been just a little softer recently also. We've noticed that also with the rental market data and the price data, but it also bounced back with big numbers of auctions and a clearance rate just over 50%. So it's been a little bit of a sideways mover as well with Melbourne, but nonetheless, we're in the mid-spring housing market now, Michael. We move up to our next break point, I guess you could call it, which is the Melbourne Cup long weekend at the beginning of November, and that signifies the beginning of the end of the spring selling season. So the mid-market is a bit more of a balanced typically, seasonally anyway, a bit more of a balance between buyers and sellers. We tend to get more stock in the market after Melbourne Cup Day, and that tends to favour buyers with more choices. So this mid part of the market will be interesting, and to see how our markets do pan out. But a lot of the pent-up demand and a lot of the buyer activity has been satisfied this year, Michael. That was subdued last year. So we shouldn't be surprised that we're now moving back to a more even market environment. But certainly I would suggest that buyers are still the underperformers in terms of the balance between buyers and sellers will still be pretty happy with the competition they're getting for their property. And we can see the trends there when we look at the Sydney trend, just eased off, as I mentioned, from those late autumn peaks, which were very strong boom time results. We shouldn't be surprised at that, particularly given we don't have any stimulus from either lower interest rates or particularly from lower interest rates to keep driving the market upwards. But that's a good thing to be finding balance. Melbourne just ticked up a little bit from the September result. results over the October result of Saturday. But again, just a little bit lower than its late autumn peaks, as we've discussed with Sydney. Brisbane similarly, just down from its peaks. But Adelaide keeps on keeping on with those plus 80%. And as we mentioned, Canberra has eased certainly over the last couple of months. Of course, you can get those auction clearance rates every Saturday night at my LinkedIn account, Dryu Andrew Wilson, courtesy of My Housing Market, and on Sunday and through Michael as well.
Yes, we do. Now, you mentioned Cup Day a couple of times, Andrew. That's also the Reserve Bank Day when they meet. And there's always been a number of years where they've brought out some surprises. I guess it's also at the time they're going to have the September quarter CPI result in front of them, so they'll be able to make a more informed decision. It'll be interesting to see what comes of it. Look forward to catching up with you again next week, Andrew.
Yeah, always lots to talk about, Michael.
Definitely. Thank you.